Hello, everyone, and welcome to our financial webcast presented by Legend Financial Advisors, entitled 2023 Mid-Year Market Outlook, Navigating Turbulence and Opportunities. My name's Dan, the moderator for the webcast today. Today's webcast presenter is Bill Knight, CFP, AWMA, PPC, and Wealth Advisor with Legend Financial Advisors. Please hold as I turn it over to Bill.
Thank you, Dan. Hey, everyone, and thank you for joining today's webcast. By the end of today's presentation, I want to make you more aware of some of the factors that will be influencing the market not only today, but for the rest of the year, and ultimately to provide you with a few tools to help you see some of the unique opportunities present today. So one of the items that I want to cover in the beginning of this presentation concern the overall money supply in the market. And there's a good quote by a successful hedge fund manager, Stanley Druckenmiller, that says, "It's liquidity that moves markets." And this is something that we saw during the pandemic, and it's something that we're also seeing now and are likely to see towards the end of the year. So when it comes to liquidity, and really what that means is the overall money supply, there's a few different factors that we're likely to see right now and throughout the end of the year. And I'm going to highlight three of those different factors. The first is regarding the Federal Reserve. And right now, the Federal Reserve banks are in the process of shrinking their balance sheets. And the effect is that will reduce the overall supply of money in circulation. So that is what you may have heard of as quantitative tightening. Now, during the beginning of the pandemic, what we saw was quantitative easing, where the Federal Reserve was trying to stimulate the economy. And we are seeing the other side of that now. And I'll show you an illustration after this slide to help create a visual for that. And that's something that's important. The Fed's monetary decisions, whether it's interest rates that we have seen increase over 500 basis points over the past 16 months, that is another part of this tightening that the Fed has done to try to slow down the economy, bring down inflation, and try to really tame prices. So that is an important factor because overall that has a large impact on money supply, and money supply has a large impact on the pricing for stocks and bonds. The next factor concerns the U.S. Treasury. So the U.S. Treasury, after the debt ceiling, is in a position where they are going to increase the size of their general account. And the greater that becomes, the less liquidity there will be in the system. So right now, presently, we're in a situation where after the debt ceiling was passed, they were at a low point of around $50 billion for their general account. Now, what happens is their intention is to increase the reserves up to roughly $600 billion by the September timeframe. Now, as that happens over the next few months, there is going to be less liquidity in the system, and that will be another factor that will have an impact on markets. A third consideration is also another factor that has changed after the debt ceiling deal. Now, obviously with the debt ceiling, we did not default, which is a positive, but one of the stipulations of the debt ceiling deal was that the student loan moratorium is over. Now, that was something that during the pandemic, March 2020, there was a freeze on student loan payments. And now payments will start happening again in October. So interest will resume in September, and payments will be due in the October timeframe is when they will begin. Now, the reason why that becomes important is that the overall student loan market is roughly $1.3 trillion. And prior to the pandemic, when the freeze occurred with student loans, the average monthly payment on those loans was $393. So in the October timeframe, there's likely to be less money in the system, especially when it comes to consumer spending, because those students who have those loans will again begin to repay those loans, and there will be more money put towards repayment of loans as opposed to spending on goods and services. And part of the strength of the economy since the influx of cash since the pandemic has been consumer spending, in addition to having strong wage growth. So that is one of the factors that could be changing over the next several months. Now, one of the illustrations I wanted to show is this is from the Leuthold Group, and this gives you perspective in terms of what has been happening with the Federal Reserve banks and how they have been tightening their balance sheet. And this shows you a graphic, and in particular, it shows you since October of last year, you can see that this number in terms of their overall assets, it was at 8.8 trillion, and this began to decline. And this declined all the way through the beginning of March. Now, March, as you're likely well aware, is the turmoil in the banking sector. So there was an injection by the Fed of lending roughly $300 billion. And you can see that's where this spike is, right here. But ever since that spike and since that injection of money into the system, there has been a steady decline when it comes to the overall money supply. And that is something where the Fed has been consistent in terms of trying to bring down inflation. And this is one of the areas where we expect this to continue to happen, and this will have an impact on the markets. Now, another area, and these are our typical charts that we typically review during our client meetings, just to give some perspective when it comes to what is happening in the market as a whole. Now, this illustration is from the beginning of the year, and it is through June 23rd, and it shows us a general idea of what markets are performing well and what indexes are performing well and what isn't. And as you can see on this chart, there's a clear outlier. So up top, the big performer has been the NASDAQ 100. So right here, we're seeing that the NASDAQ is up almost 40%, and it's had a very strong start to the year. And this is really a reversal of what we saw last year with the NASDAQ being down over 33%. And really what we've seen in that sector is a combination of those companies towards the beginning of the year and late last year having jobs cuts and reducing their overall expenses. And from there, we've seen a select few of those companies, such as NVIDIA, for example, a semiconductor company, have not only strong earnings, but strong estimates in terms of what their future growth will be because of artificial intelligence and some of the technology that has been developing there. Could be ChatGPT and Microsoft, which has been in the headlines a lot over the past several months. And a lot of the tech companies have really benefited from that. It could be some of the big companies like Apple and Microsoft, Companies like Amazon, Tesla have done really well. NVIDIA has been the big performer. So that's what we've seen so far this year in terms of kind of the outlier with the tech industry. Now, outside of technology, you can see that the S&P has done pretty well. There's less overall technology exposure in the S&P 500. International markets have done relatively well. But outside of those, if you were to average these other indexes together, you're kind of at almost a break even, where commodities has been the underperformer. Now, taking that a step further, if you were to look at the individual sectors that make up the S&P 500, this gives you just further feedback in terms of what has done well and what hasn't done well. You can see at the bottom, what hasn't done well are some more of the defensive sectors that will typically do well in a bad market. So sectors like utilities, for example, or some of the consumer defensive sectors. And what has done well is a combination of technology, communication, which is companies like Meta, for example, and Google, and then also consumer discretionary, which is companies like Amazon and Tesla, typically make up a large portion of those indexes. So with some of this as a bright spot in terms of what has occurred this year relative to last year, what is the opportunity set that you have in front of you in terms of how you can take advantage of this opportunity? So one of the areas that we've been utilizing for our clients over the past couple months is general rebalancing. And there's really two different approaches to rebalancing that you can take. And this is a nice visual from Michael Kitz's website that talks about two different methods of rebalancing for your portfolio. On the left is a tolerance band rebalance. So what this means is, in this scenario, this shows what the equity allocation would be, and they start at around 50%. So they put a threshold at 60%, where, for example, if you were targeting 50% for your equity allocation, if that overall allocation went above 60%, you would then rebalance. On the other hand, if you were to rebalance your portfolio on an annual basis, you would just do that at the end of year 1, at the end of year 2, and at the end of year 3, for example. Now, what we've preferred in this type of environment is to use a tolerance band rebalance, because what that does is, as certain areas like the NASDAQ, excuse me, or the semiconductor area in particular, areas that have done really well in client portfolios, as they have outperformed this year, we've typically seen them exceed what our target allocations have been in portfolios. As a result, we have rebalanced those to the initial weightings. And what that does is it allows you to trim back some of the positions that are doing really well in the portfolio. And there are also some of the positions that historically might be overvalued in a period like today. So this is a strategy that could be used for individual stocks. It's also a strategy that can be used for mutual funds, exchange-traded funds, or other holdings in your portfolio. So this is something that has worked well for us, and it typically gives you a large enough range where you're not making trades too often, but you are able to take advantage of some of the opportunities in the market that have performed exceedingly well and take some of the profits off the table in case we were to enter any type of down market or see further volatility. So that is one of the opportunities that we see in this current type of environment. Now, the next slide that I'd like to talk about, and this is really the question that everyone tends to ask, is are we in a new bull market or are we in a recession? And if you scroll through, whether it's the Wall Street Journal, Bloomberg, Yahoo Finance, or just turn on the television, there's always different types of analysts talking about their views as to whether or not we're in a bull market or a recession and what to look for. So I want to go through just a few indicators that are causing this type of discussion and try to provide some insight into that. So the first part is, are we in a bull market? Now, a lot of people who think that we're currently in a bull market think so based upon the 20% rule. And that is typically one of the indicators that will identify a new bull market. And the idea is that if you have an increase greater than 20% from a low, you are in a new bull market. And for example, the S&P 500, since the October low, which was October 14th, it has rallied 22.26%. And that is as of the market close yesterday. The NASDAQ, on the other hand, which is the index that is more technology heavy, that has rallied over 38%. So according to the 20% rule, which is typically used, we could be in a new bull market. However, there are other indicators that some analysts think that we may actually be approaching a bear market, and that this recent rally could just be a short-term bear market rally. So when it comes to a bear market, similar to what we discussed in the beginning of the year for the forecast for 2023, we still have an inverted yield curve. And that's what I have for the illustration here on the right. And I'll explain that in a moment. But in an inverted yield curve is just an indicator that we could be having a recession. And that is when the yields for short-term bonds are higher than long-term bonds. And typically in a healthy economy, it is the opposite, where you should be compensated more for long-term bonds as opposed to short-term bonds, because you're holding longer-term bonds for a longer time frame and you're not going to receive your initial principal payment until the end of that time frame. Now, what's interesting about this specific yield curve is that it has accurately forecasted 8 out of the last 8 recessions. And this is one of those examples. And what it does is this blue line here is it shows you the time frame of when the yield curve inverted. And this was the bear market that occurred from 2000 to 2002. You can see that in 2000 was the yield curve inversion. And it wasn't until 2001 where we actually had a recession. Now I'm going to show you a few more examples. If we fast forwarded 2006 to 2009, you can see that in 2006, we had a yield curve inversion, and that again accurately predicted a recession that would occur in 2008-2009 timeframe. Now notice with these illustrations that the market still continued to rally, and this is the S&P 500, it still continued to rally after that initial yield curve inversion. So for this time frame during the Great Financial Crisis, this was a positive 23% that the market still rallied. And then if we fast forward to the short pandemic era recession, you can see that we had a yield curve inversion in 2019. The market still continued to rally, up 19%, and then we have the short recession that we experienced in March of 2020. And now here's the interesting part. This is an update, and these illustrations are from the Leuthold Group. This illustration shows that for this specific yield curve, the inversion was in November of last year. Since that inversion, we've had a rally of over 12.5%, and we're at a point in time where a recession based on this indicator is becoming more likely. And some of those aspects when it comes to a decrease in the overall money supply in the economy could have an effect. And so that's something to be aware of. And one of the kind of the contrasting scenario of there's certainly bullish areas to consider, whether it has been consumer spending in the past, wages have and unemployment have remained positive, but there are certainly factors that could lead to a recession or at least some type of slowdown in the economy. So all of these items, it comes back to ultimately, what does this mean for you and in your portfolio? So we want to kind of leave you with a few different tools that you can consider when it comes to how you can make better decisions when it comes to your portfolio. Now, one of those areas is, and this is a tool that we offer for free on our website. It is a risk assessment and a stress test that we offer for prospects, for our clients when there's any type of lifestyle changes or when there's any type of change in your overall tolerance for risk. And typically that can happen maybe when there's a downturn, or maybe you're getting closer to retirement, or maybe you're already in retirement and you're starting to feel a little bit more conservative. And what's interesting about this illustration is this is a stress test. And what we did is we put in a traditional 60-40 portfolio. So that would be a portfolio that would be targeting roughly 60% in equities and 40% in debt or fixed income or bond-like investments. And what it does is it gives you a score based on 1 to 99 in terms of the overall risk level for that type of portfolio. Now for this particular portfolio, the risk is a 50, so kind of middle of the road, and it compares the portfolio to different historical events and how the S&P 500, for example, performed. Now, something like the S&P 500, that is an all-equity index, and its respective risk score would be a 76, so more aggressive. And what it tells you is that for this type of portfolio, if we were to experience a time frame like 2013, and that's for the entire year, when the S&P 500, for example, which is more aggressive, was up over 32%, for this type of portfolio, you could expect a return of 15.8%. So obviously not taking as much risk, you wouldn't expect the same amount of upside potential. And on the other hand, if we were to experience a bear market, and this is using also an annual time frame for 2008, for example, The S&P was down 36%, and this type of portfolio, which is not as aggressive, was down just over 18%. So this is a nice way to be able to have an idea of how your portfolio would perform in some of these different historical scenarios. So for example, if we were to enter a bear market, this one in particular is actually during the financial crisis. And this is a time frame where from October 15th of 2007 through March 2nd of 2009, the S&P 500 lost 53%, whereas this type of portfolio will lose over 27%. And they even get into scenarios where interest rate spikes would happen and how your portfolio would react. So what becomes interesting about this is sometimes we will see prospective clients who might have a portfolio that's more like an S&P 500 risk level, but their actual risk tolerance might be more conservative, like a 60-40, or something even more conservative than this. So what becomes appropriate prior to any type of recession, for example, or any type of down market is really to understand your portfolio and to make sure that it is an appropriate fit for you and what makes you comfortable. And that's really one of the first steps. So this would be a helpful tool if that is something that you're not certain about, or if you think there's any disconnect. The next tool that is helpful for us, and this really comes to how can you manage risk? And one of the best ways to manage risk is through diversification and proper diversification. And what I mean by that is, I'll first explain this chart, which is a correlation matrix. This is an illustration we get through Morningstar, which is one of the analysis reports that we use often for prospects and clients. And it gives you a breakdown and lets you know that among the investments that you're currently using, how correlated they are. And correlation is really just means how much they go in the same direction in terms of their underlying performance. So for example, anything in this navy blue color in this key here would have a high correlation, meaning that for any of the investments in navy blue, if they were to go up 1%, those same investments would go up a very similar amount. On the other hand, anything that is moderately correlated, kind of in this gray blue, they have more of a moderate correlation where they will not move in the same way. Then we have no correlation, which as you can see that there's several investments here that have limited correlation. And then there's even some that have a moderately negative correlation. And that means as one investment goes up, the other investment in the portfolio might actually go down. And it gives you a different set of returns where over time, having a collection of diversified investments will allow you to have a smoother ride and will really smooth out the overall volatility in your portfolio so that you're not experiencing those large type of drawdowns like we saw for the S&P 500, for example. So there's a variety of asset classes that we have in here, whether it is gold bullion, it could be a trend following fund like managed futures, it could be different types of bond funds, or even funds that have a more specific allocation to a certain sector, like healthcare, for example. Commodities is another one of those asset classes that helps provide strong benefits of diversification. And it's important to also recognize that having assets that are negatively correlated or have little correlation doesn't necessarily mean that there will be a negative return. All it means is that the overall return profile is different. And typically what we see is that some portfolios might have a number of different investments, but sometimes, specifically for target date funds, a lot of times you'll see a lot of navy blue when we put these into our analysis and do this for potential clients. So that is something that becomes important to be aware of when it comes to managing your portfolio. Now, one of the next items that I'd like to cover is in terms of what is the current opportunity set when it comes to more of a long-term view. And we talked about this chart a little bit in the webcast at the beginning of the year, and it is from GMO. And they are a group out of Boston, and they go through this 7-year asset class real return forecast. And its real return, what that means is the return numbers indicated here, these are numbers after inflation. And the way that it's set up is that it's an annualized return over a 7-year time frame, and it is done on the left for stocks, different asset classes in the stocks section, and then on the right you have the asset classes for bonds. And you can see that overall, given where valuations are today, there's still a negative expected return for stocks, for US large cap stocks. Now, interestingly enough, this is the one area of the economy that has done the best so far year to date with all of the rally in technology stocks. It's also the area that is the most overvalued. From there, US small stocks has a slight negative expected return. And then once you get into the expected returns for international large cap stocks, it is positive. International small cap stocks, and then we get into emerging markets. And those have the highest expected returns given where their valuations are today. So that's something that we have performed our due diligence on really since the end of last year. And that's something that we are looking to add to the portfolios at some point in time. But we've been a little bit more selective in terms of the timing, just given some of the market factors over the past several months, whether it was the turmoil in the banking industry and what has occurred with the US dollar. So it's another consideration to think about when managing your portfolio is some of the different asset classes to include for long-term growth. And keep in mind, this is for a variety of different asset classes, bonds included, but it also doesn't include different asset classes like commodities, gold bullion in particular, or some of the other unique asset classes like managed futures. Now, once I go to the next slide, this slide in particular was to address one of the questions that we had prior to today's webcast. And the question was, if we were to enter into a secular bear market, and what that means is a long-term bear market, what would be our positioning and kind of how would we approach that situation? And it's a really great question. And so what we've pulled up is, this is an illustration that shows for the last secular bear market that occurred from April 1st, 2000 through December 31st of 2011, so lasting 11 years and 9 months. These are the different asset classes and what they return on an annual basis, as well as what their total returns were. So you can see that the S&P 500, for example, the total return over that time frame was 4.42%. Very small. And obviously, with that being a bear market or a down market, that can be expected. And if we were to have a similar time frame, and really if you look at the asset class forecast that we just saw from GMO, the expected return was actually negative for the next 7 years for something like the S&P 500 or US large cap stocks. So there are a variety of asset classes that will or should perform well in this type of market environment. So what we do is we do look at the past and we identify some of those asset classes that will perform well in a secular bull market if we were to have one. And if you look at the bottom, for example, gold bullion actually had the strongest performance. So gold bullion is not only a nice diversifier in the portfolio that will perform well in a down market. So far, that's been up anywhere from about 7 to 11% so far this year, which has been a nice addition to the portfolios. But there are several other asset classes, real estate, for example, commodities, being up over 42% during that time frame, managed futures, so that's a trend following fund. And those performed really well last year, for example, being up about 16%, as were commodities. So there's really a number of different asset classes where if you have a diversified portfolio, that you can still have a good return from utilizing some of these different asset classes. So with that said, I will open it up for Q&A. So feel free to submit any questions about what we've talked about so far, and I will do my best to address those questions. So one of the questions that was submitted was in terms of where to place money in banks in order for it to be safe. Now, when it comes to putting money in banks, and this is a question that became much more relevant when we had the banking turmoil in March. And what we saw is that really it was about the FDIC insurance. And that is the Federal Deposit Insurance Corporation. And they back deposits at banks for an amount of $250,000. And that is the standard insurance limit. And the way that it works is it is per depositor, per insured bank, and for each account ownership category. So for example, if you have an individual account and then a joint account at a bank, those would both be covered for the amount in cash. So it becomes important to make sure that you're not exceeding those limits, even though when the Fed had lent money to banks with that 300 billion amount that we mentioned in the beginning of the webcast, that was something that even the uninsured depositors were being made whole. Now, we can't say that that would happen again in the future. So we suggest to clients to make sure that you're within that $250,000 limit. And then when it comes to monies that are at a brokerage account, so that could be like your TD Ameritrade, Schwab, Fidelity, for example, those tend to have different investments that have the SIPC insurance. And The SIPC is the Securities Investor Protection Corporation. So it's a similar type of insurance that as the FDIC for banks, but this is for brokerage accounts. And it offers protection for brokerage account in the event the brokerage firm were to fail. And the protection amount is $500,000, and that includes a $250,000 limit for cash. So those would be recommendations in terms of, or not necessarily recommendations, but considerations in terms of what to think about in terms of having your money safe at banks. And there's a question on the role of digital currency as the US dollar declines worldwide. So that's been an interesting topic over the past several years in terms of digital currencies. When it comes to something like Bitcoin, for example, that is not an area that we have pursued in terms of investment or any other type of digital currencies. And the reason is because they are not regulated by the SEC. And we have seen issues this year in particular with the fraud of Sam Bankman-Friedman, for example, and some of the other companies in those industries that have not been serving customers in the way that the customers initially thought or what was intended. So given the lack of regulation, we haven't pursued those. And it could be something in the future if there was further regulation in that industry and the currencies were actually used where you could rely on the overall price of the currency. So for example, something like Bitcoin has large fluctuations where I think this year it's been up anywhere from 50 to 100%. Last year it was down 75%. So obviously you need something that is stable for a currency. And there's certainly talks of the different central banks throughout the different economies of having their own currency, digital currency. So it's certainly something to pay attention to, but I think until there's more regulation and security in that environment, that it's something that we will continue to monitor and make sure that we're kind of acting in the best interest and doing our own due diligence. That's a good question. So those were all the questions that we've had for today's presentation. Thank you all for joining. And for now, I will hand it back over to Dan.
Okay, great. Thank you, Bill. A lot of current and good information that you covered today. And I want to thank everybody for joining us. If you'd like to schedule a free conference call consultation with a member of our advisory team, please call our office at 412-635-9210 to set up an appointment. Thank you again for attending, and this concludes the event.